the globe. According to the latest data from real estate consulting firm JLL, commercial real estate investment in Asia Pacific totaled $27 billion from January to March, and that marks a 30% decline compared to the same period last year. Growth was uneven across the region, with a near 5% surge in Japan, but a 26% contraction in Australia. Interest rate headwinds and repricing efforts among top bugbears for the market, and JLL says the outlook ahead continues to be challenging. To dig deeper into commercial real estate investment in the region, we have Roddy Allan, Chief Research Officer, Asia Pacific at JLL, and he's joining us for an exclusive chat from Bangkok today. Roddy, great having you on the show. Now, talk to us more about your latest research, the Capital Tracker for Q1 this year, especially the main drags behind the 30% drop in commercial real estate investment. How has the tightening of lending standards in the West added to the equation here in Asia Pacific?
I mean, Olivia, I think we are, to be honest, to some extent, are relatively insulated here in terms of what's happening in the West. However, we're certainly not immune. What we are seeing is with the rise in interest rates that we've been seeing over the past number of months, that is impacting the real estate situation, and continues to be challenging from the perspective of trades getting done. And that's really driven by that gap between buyers and sellers' expectations as a degree of some repricing plays out. Now, the Americas and EMEA are probably further ahead than Asia Pacific in that. But as you mentioned, we've seen a mixed picture across the region with volumes up in Japan, actually very much driven by owner-occupiers disposing of assets and J-REITs picking those up. But a more challenging time for markets like Australia, where the sort of impact of hybrid working, along with the interest rate rises, has been taking its toll. However, I think longer term, what we do expect, there's no shortage of interest or capital waiting on the sidelines. So this is very much a short to medium term situation as the year plays out.
Roddy, let's talk about subsectors now. As we know, office among the sectors that are softest on record. Which one is the most resilient of them all?
I mean, I think if we look at all the sectors, it's a pretty mixed picture. And if we look at office, as you say, we've seen the volumes down considerably. And that's not, I would say, in the main part due to any concerns about return to office, with Asia Pacific return to office rates higher than all other regions. But it is being driven by that interest rate situation that I've mentioned. When we look at the retail sector, we are seeing retail spending coming back, which is highly encouraging. At the same time, retail also remaining challenged, and a similar situation in hotels. Now, tourism coming back. I heard you mention in the show earlier, the domestic tourism rates in China, which are now surpassed in pre-COVID levels. At the same time, it is really that interest rate environment and the general uncertainty over global economies that's weighing in volumes at the moment. But as I say, a short-term phenomenon and something we'd expect to start picking up as we move across the year. And certainly a much brighter picture for volumes expected in the second half of the year.
Talking of short-term phenomenon, in your research late last year in November, you found that companies were paying more to rent space in green certified offices in major Asian cities. That's talking about 28% premium. With the softness in investment activity so far this year, how has that affected funds pouring into the green space?
It's very interesting you asked that question. I've just had a number of meetings on this exact topic yesterday. I mean, we don't expect to see any change over the medium to long term. In fact, many of our clients telling us that it's something that they are looking at very keenly, because by our own calculations and the anecdotal evidence our clients are looking at, there will not be enough ESG certified assets over the next 5 years to meet demand, and that will drive that rental premium which we, as you mentioned, we have our report out on. At the same time, as we play through this we see a continued bifurcation of the markets where those higher, better quality assets are commanding a rental premium, and those lower quality assets that are not future-proof, seeing rents impacted. Now, we expect that trend to continue, and where there are rental premiums, there'll also be price premiums, and that's something that the investment community will be chasing. They'll also be chasing these assets to also meet their own ESG commitments that many of them have already made.
Great. Thank you so much for today, Roddy Allan, Chief Research Officer, Asia Pacific at JLL. And that's latest in business for